So one of the lenders that we use produces a monthly market update that rounds up all of the data that I look at on a daily basis in my job as a mortgage broker. So I've decided that I'm going to start to do a feature every month where we go through this report just to see how the economy is changing and what that might mean for the mortgage market going forwards. Before I get into that, if I can ask you to please do like and share the video, it really does help the channel. And as a reminder, there will be a link to this report in the show notes if you're watching this video on YouTube. So let's take a look at the report. So first up, the overview. So while figures later this month might show that inflation has hit the 2% target in April, the rate may not stay there for long. Petrol prices, as you probably noticed at the pump, are on the rise, and early survey evidence shows pressure on firms' costs have increased sharply with the rise in the minimum wage, which came in April. The same surveys that point to rising costs also confirm that the recovery is gathering pace, led by the service sector, with financial services and tech/IT the strongest performers. But transport and hospitality are clearly struggling. Those industries were high up the league table of business insolvencies over the last year, and more firms believe they are at moderate risk of failure than at the start of the year. Although the unemployment rate has risen from 3.8% last year to 4.2%, the story here is not so much about workers losing their jobs, although a few more are, than a reflection of it becoming harder to find a new role. Long-term unemployment, along with inactivity, are constraining the economy, and we're not seeing much growth. With real wages lifting, consumer spending, GDP is expected to grow to 0.7% this year and 1.5% in 2025. A small rise in the unemployment rate to 4.4% is forecast, while inflation is expected to hover a little above target until spring next year. And this is what I've been talking about in the update videos, where I've been saying that you see the services inflation is one of the key things that's affecting the Bank of England's decision. They want to make sure that inflation is completely under control before making any rate decisions so that they don't have to reverse those rate decisions later on. As you can see, the economy was unable to live with real interest rates of 3% over the last decade. Some areas, particularly the housing market, are struggling under the strain. While house prices stabilise as mortgage rates ease, affordability is still stretched. Big falls in house prices seem unlikely if the rest of the economy is recovering, and it is something that we're not seeing. Obviously, there was talk of 20 to 30% property price falls. It's just not come to fruition at all. But the fundamentals, notably the proportion of income spent on a new mortgage, still suggest valuations are too high. And we are seeing a little bit of that, especially now with interest rates on the up again. Geopolitical risks, while always present, feel like they are growing. The election of a new US president is an event with implications well beyond its own borders. More trade protectionism could be on the cards, whoever wins. A win for Donald Trump would shake up the world order, embolden Putin, and put much more pressure on Europe to take responsibility for protecting its own borders and paying for the Ukraine's defense. So as you can see, the things that affect the interest rates here in the UK are not just within our own shores. Worldwide events can have a huge impact on the money markets, which does directly link to mortgage rates. So let's take a look through each section of this report. I'm not going to go into it in a huge amount of detail. As I said, there will be a link to this on YouTube. So if you do want to go take a look at it and have a read for yourselves, then please feel free to do so. Inflation and interest rates. So inflation didn't fall as much as hoped in March, while a return to 2% in April is still quite possible. The stickiness of prices in the service sector may prevent early cuts in interest rates, which is what we've been saying all along. Petrol prices, as you've probably seen if you drive, have been on the increase, and this was even before the unrest in the Middle East with Iran and Israel. It does say reading too much into 1 month's numbers would be a mistake because things can change very, very quickly. But obviously, it's important to keep an eye on things on a month-by-month basis. And then he says, even if inflation could briefly be back to 2%, the elevated level of service and wage inflation mean markets have significantly pulled back their view on how quickly rates will come down. August now looks like the earliest the bank will be ready to move unless wage growth weakens significantly in the next couple of months. And if you watched yesterday's video, you'll note that wages had actually increased. Over on the right here, we've got some data. I'm not going to go through them. You can have a look at those for yourself. Moving on to the labour market. It's difficult to find anything positive in the latest labour market news, although the figures are volatile and subject to sampling issues. Inactivity is up, employment rates are down, and the unemployment rate rose to 4.2%. This isn't putting much downward pressure on wage growth, which is not retreating as the Bank of England would wish. The latest reading makes a June cut in bank rate less likely. And of course, this has been triggered by the big rise in the minimum wage in April, which looks like a key economic event, both in terms of the impact on wages and monetary policy and employment in low-wage industries. Moving on to the housing market, the signals are mixed. Agents are more bullish about the prospect for both activity and asking prices, but with quoted mortgage rates edging up over the last 3 months, house prices have started to fall again, with the nationwide reporting another 0.4% drop in April. Of course, higher mortgage rates is affecting people's affordability, and the deterioration in first-time buyer affordability still makes it possible to argue that valuations are 20% too high. But without forced selling on a large scale, such falls look less likely than 6 months ago. And one potential source of forced selling could be from buy-to-let landlords who are struggling with higher interest rates. For now, the impact looks marginal, but the landscape for buy-to-let may change with the government, and it is something that we've seen a huge drop-off. I deal with a lot of large portfolio buy-to-let landlords, and they're just not doing anything at the moment. So moving on, rental market. Demand for rental property in London is falling again. That supports the view that we're reaching the limits of what affordability will allow in the south, and we are starting to see people shift their horizons north. The surge in rents has helped improve the economics of the buy-to-let investment decision over recent months, although this could quickly change if interest rates do stay higher for longer. The ONS measure for capturing the price of all rents, up 9.2% year on year to March, will stay high as expiring tenancy agreements are renegotiated to reflect current market conditions, and they may not be much lower by the year end, and it is something that we're seeing. Obviously, people that are renting property are affected by this as well as those that have mortgages, but with the rents that landlords have been charged on some of the mortgages where historically the rates have been really low, those transactions no longer work, and landlords are having to increase the rents just to cover the mortgage costs alone. So moving on to mortgage market activity, unfortunately, the lower interest rates that would unlock the market look further away than a few months ago, and activity has improved but remains subdued, which is something that we mentioned yesterday. We are starting to see more inquiries, but those are not yet turning into actual physical transactions. Potential sellers are coming back to the market. Lenders say that credit is available, which it is, but stretched affordability means that buyers are still limited in the supply. Those that are in the market are still taking out shorter length fixed rates in the hopes that rates will be lower in 2 years' time. And this is something that I've mentioned numerous times. People are focusing on 2-year rates right now. There's only the odd person that's taken a 5-year rate because it's the cheapest. But we need to shift our focus away from the interest rate decision when we're looking at a mortgage to more about what suits your own personal circumstances. Moving down onto mortgage rates, monetary policy is clearly restrictive. The key question is whether the bank will look through the unhelpful short-term news on inflation and wages or look at the bigger picture. Market expectations have been volatile, but for now, pricing 2 full 25 basis point cuts in the bank rate later this year. But as I mentioned, Andrew Bailey had hinted he thought that this was wrong, that there could be potentially more than 2 base rate cuts this year. Didn't say that for certain, but he said it was certainly a potential. The expected delay in rate cuts to August instead of June means that the falls in mortgage rates are now further away from what we thought previously. But the markets have been steady this last week, and we have seen a couple of lenders increase rates and a couple of lenders decrease rates. So possibly there is a change on the horizon. Many lenders have raised mortgage rates recently. The trend is seen in the quoted rates for mortgage lending, which have crept up in the last couple of months. As a result, we expect product rates to remain elevated in the near term, yet the incentive for remortgaging does remain high, though many are still with their existing lender. And this is something that we have seen a lot. People just having to do product transfers rather than actually switching lenders because of affordability problems. That's a quick overview of this report. As I said, once again, there is a link to this report in the show notes on YouTube. So if you want to take a look, please do go over there and click the link. Once again, as a reminder before I go, please do like and share the video. It really does help support the channel. Thanks very much for your support. Please do keep the interaction and the comments coming. But for now, take care.